All right, let's jump right into today's explainer. We're breaking down a massive, high-stakes corporate turnaround story today. We're looking at Teva Pharmaceutical Industries, running a full due diligence check on the stock. You know, for the longest time, Teva was just seen as the struggling generic drug maker, completely bogged down by a mountain of debt and brutal pricing wars. But recently, they've been attempting this incredibly ambitious pivot, trying to morph into a hybrid biopharma innovator. It's a classic turnaround setup. Heavy financial leverage, shifting product mixes, and basically a sprint to launch new, highly profitable drugs before the old legacy generic revenues dry up.
To really wrap our heads around where Teva is standing today, we've got to look at where they just came from. Peter Evans from the Sound Shore Fund really hit the nail on the head here. He literally called Teva the poster child for dead money right up until new management stepped in back in 2023. I mean, investors had practically written them off completely. The debt from past acquisitions was just suffocating the company. And growth? It was basically zero. But honestly, that exact baseline of struggle is what makes their whole pivot to growth thesis so interesting to dig into right now.
So here's the roadmap for our due diligence today. First, we'll do an overview of the Teva turnaround. Then we'll check their financial health and deleveraging. Third, we'll dive into the innovation and growth engines. Fourth, we've got to talk about industry risks and headwinds. And finally, valuation and market sentiment. Let's get to it.
Starting off with Section 1, Overview, the Teva Turnaround.
Ever since CEO Richard Francis took the wheel, he's been aggressively overhauling the company's identity and its finances. And it's a real balancing act. They aren't just abandoning their generic roots. Instead, it's this hybrid approach. They're sustaining that reliable, cash-generating generic powerhouse on one side and using that cash to aggressively build out high-margin, innovative brands on the other. It's all about using the old reliable stuff to fund the shiny, expensive new treatments.
Management officially calls this their pivot to growth strategy, and it's built on four main pillars. First up, delivering on their current growth engines, specifically the drugs Austedo, Ajovy, and Uzedy. Second, stepping up innovation by bringing in new pipeline assets like olanzapine LAI and buying up Amylax Biosciences. Third, keeping that generic powerhouse humming, mainly by leaning hard into biosimilars. And fourth, focusing the business, which includes a pretty strict target to carve out about $700 million in net savings by 2027. The big takeaway here? These aren't just empty corporate buzzwords. These are the actual targets driving their real-world 2025 and 2026 financials.
Moving on to Section 2, Financial Health and Deleveraging.
Look, you absolutely cannot talk about Teva without talking about the elephant in the room, their balance sheet. Debt has been the massive, heavy anchor dragging down their valuation for years. $12.8 billion. That is their net debt as of the first quarter of 2026. Yeah, it's a staggering number, but context is everything here. Management has been incredibly aggressive about paying this down. In fact, between 2023 and 2025, they were knocking out over $1.5 billion of debt every single year. They're actively chipping away at that anchor.
And you know what? The credit markets are definitely paying attention. Fitch actually just upgraded Teva to a BBB- with a stable outlook. That is a game changer for their financial flexibility. Fitch is projecting Teva's annual free cash flow to top $2 billion, which is plenty of cushion to keep paying down debt while still making modest investments. Management's medium-term goal is hitting 2.0x net EBITDA leverage. Plus, they have a pretty big wildcard in play, the potential sale of their TAPI division, which stands for Teva Active Pharmaceutical Ingredients. That sale could bring in over $1 billion to speed up the deleveraging even more.
What's super interesting is seeing how this whole strategy is already showing up in their profitability metrics. Just look at the structural improvement in their gross profit margins from Q1 2025 to Q1 2026. We're seeing GAAP margins bump up from 48.2% to 49.5%. That isn't an accident. That's the direct result of the portfolio mix shifting. As those new, higher-margin, innovative drugs become a bigger piece of the overall revenue pie, the entire company just becomes structurally more profitable.
Next up, Section 3, Innovation and Growth Engines.
If fixing the balance sheet is the foundation, then these innovative drugs are the rocket fuel for the stock. They are completely reshaping where Teva's money comes from. Just in Q1 of 2026 alone, Austedo raked in $578 million. Ajovy brought in $196 million, and Uzedy hit $63 million. Put those together, and those three brands grew by a massive 41% year-over-year in local currency. Uzedy, by the way, which is a schizophrenia treatment, is actually the fastest-growing long-acting injectable on the market right now. It's nearly doubled the entire risperidone market since it launched.
Looking down the road, there are some major catalysts that analysts have their eyes glued to. In Q2 2026, they're expecting European acceptance for olanzapine LAI, another long-acting injectable for schizophrenia. Then in Q3, they expect to close that MLX Biosciences acquisition, which hands them a first-in-class pediatric Tourette treatment. And then the big one, Q4 2026, is the anticipated U.S. launch of olanzapine LAI. A lot of analysts actually see this U.S. launch as the single most meaningful catalyst for Teva's next chapter. It could potentially push their whole schizophrenia franchise past the $2 billion mark in peak annual sales.
But we definitely shouldn't ignore the non-innovative side of the house. Teva still holds the second-largest biosimilar portfolio in the whole industry, and they're fully on track to hit $800 million in biosimilar revenue by 2027. They also just scored FDA approval for Ponlomzy, which is a biosimilar to Prolia. It just proves that their foundational generics engine is still very much alive and kicking.
All right, let's flip to Section 4, Industry Risks and Headwinds.
Any good due diligence explainer has to look at the ugly side too, and there are some very real challenges here. While Teva has those amazing growth engines we just talked about, they are also swimming against some massive currents. For 2026, Teva is staring down an estimated $1.1 billion revenue cliff because of new generic competition for Revlimid. And looking a bit further out to 2027, their absolute star drug, Austedo, is facing risks from the Inflation Reduction Act's Medicare Part D price negotiations. So their new growth engines basically have to work overtime just to fill the hole left by these legacy declines.
And actually, that $1.1 billion Revlimid headwind, that's exactly why Teva's 2026 forecast totally disappointed the markets recently, which caused the stock to slide, even though their 2025 earnings were actually pretty strong. On top of that, Fitch estimates Teva is going to have to eat between $600 and $750 million in annual cash costs over the medium term, just dealing with opioid litigation settlements and restructuring. Throw in the general pricing compression that's just a constant sector-wide risk in the generics market, and you can see why free cash flow is always under pressure.
Finally, Section 5, Valuation and Market Sentiment.
So how is Wall Street digesting all this? We have to see how investors are pricing this really complicated mix of heavy debt, solid growth, and transition risk. When you line up their valuation metrics against the broader market, a really clear picture pops out. Teva's trailing PE is 28, which is actually a bit higher than the S&P 500. But wait, look at the forward PE. It's sitting at an estimated 12.6 compared to the broader market's 21.9. That is exactly why funds like Soundshore are arguing that the core business is trading at a massive discount right now. The market is very clearly slapping a debt and generics penalty on the stock, completely discounting the growing biopharma revenues.
But management is throwing out some incredibly confident signals to fight back against that bearish narrative. They've set an aggressive target to hit a 30% non-GAAP operating margin by 2027. They're loudly touting a $10 billion pipeline potential in immunology and neurology. The board even straight up instructed management to start planning a share repurchase program. I mean, buybacks are the ultimate signal that a company thinks its own stock is cheap. Plus, they've got heavy-hitting institutional backers like Norges Bank and Migdal Mutual Funds sticking around. It shows that the smart money is buying into this turnaround story.
Which brings us to the ultimate question. As someone analyzing this stock, you have to weigh that incredible 41% growth in their innovative drugs against those billion-dollar legacy headwinds and the $12.8 billion in debt still sitting on the balance sheet. Teva is absolutely no longer dead money. But is their pivot to growth already fully priced in at this discount? Or is this massive corporate turnaround really just getting started? I'll leave you to chew on that. Thanks for joining this explainer, and we'll see you next time.